firms that your book calls firms in pure competition. I prefer the term price takers. It describes it a bit better. And what we're trying to do is we're trying to figure out a whole bunch of decisions that firms make. First decision is, do you enter? The second decision is, how much do I produce? Third decision is, how do I respond? To changes in price. And the fourth decision is, when do I exit? There's actually also a fifth decision. It isn't part of the actual dynamics of the process, but it's also what happens if I want to sell the firm, which may mean you're in a position where you're producing or you're not producing, or you're making profits or you're not making profits. But we're starting off with this idea of here. And the first salient point about price takers is that there's so many buyers and sellers that the actions of a small number of buyers and sellers has no impact on the marketplace. So if you're a wheat farmer and you decide not to produce wheat, that's not going to change the price of wheat in the market because there's a national price for wheat. And likewise, the same thing applies on the purchasing side. No one has enough market power that they impact anything. Everybody sells the same thing. The goods are homogeneous. And what we really mean by that is when you're the producer and you're producing wheat or corn or you're selling Snickers bars, your buyers out there are looking, and they don't care whether they buy it from you or somebody else. They just want the Snickers bar or the wheat or whatever it happens to be. And you can't differentiate your product from somebody else. Now what we're going to see is that when we move to a different type of market firm, which is a price searcher, it may differentiate its product just because it happens to have gasoline or Snickers bars or beer in Vantage, Washington, and you're out of gas, you haven't eaten all day, and you want a beer. So they're able to distinguish themselves because there's nobody else selling that stuff nearby, and you can't make it to Ellensburg. That's a different issue. What we're talking about here is that we got true blue homogeneous goods in the marketplace. And what we'll see is that there are degrees of homogeneity as we wander through this. There's good information. In other words, buyers and sellers knows what the prices are, so that no one's sitting out there going, oh, no one really knows that they can buy this stuff a mile away. So what's happened with the internet is an interesting term that's used on Wall Street. They talk about all sorts of goods becoming commoditized, which simply means they become these homogeneous commodities because the internet tells you really fast where it is, what the price is, all this other stuff. So that's having cheaper and cheaper and cheaper information leads us more and more into these price takers markets. And then the last one, as we'll see, is easy entry. And exit. We're looking at industries and commodities where if you want to go farm wheat, you can go farm wheat. If you want to sell Snickers bars, you can sell Snickers bars. It's not as if you have to own a bauxite plant or mine in order to make them from them. You may have some monopoly power in that case. In this case, we're talking about there's just anybody that wants to do this can do this. And this first. So we have to distinguish, and when we're talking about the firms, we distinguish between the actual market for the good, the homogeneous good, which in this case we're dealing with corn. So this is, we'll just say, the United States market for corn. But this market's made up of lots of buyers. Is that a no? That's lots and lots of buyers. Okay, so there's all these people out there buying corn for one purpose or another. You're either buying it because you're having a barbecue, or you're buying popcorn, or you're buying it because you're making Frito chips in your Pepsi-Cola, or you're buying it because you're making ethanol and you're making corn whiskey or putting it in gasoline. You're part of this marketplace. And then these are all farmers. Farmers, and we'll say that there are 12,727 corn farmers. That's way low. 412,000. Lots of farmers. And the point here is that in this marketplace, where you've got millions of participants over the course of a year, nobody has any market power. Farmers can decide they're going to retire. Their cornfields can burn down. You can have some small problem occur in the Midwest, and 20 miles of corn gets wiped out. It has no effect on the overall supply of corn because those farmers just have a tiny, tiny bit of the marketplace. And the same thing with the supply, or the purchasers. We just have so many individuals that individual decisions by one firm that's buying corn or one gasoline company that's buying ethanol has no effect out there. Now, that's not to say that these markets don't change, because what happens if, which might happen this summer, I guess it's not going to happen in the Midwest, what happens if there's a big drought? So all of a sudden it's more expensive to have corn, everybody's would cut back on supply because it's harder to produce corn, the price is going to rise generally. But we're not talking about that sort of impact. We're talking about individuals making decisions. All these sorts of impacts, technological change and droughts and all that sort of thing, is still going to impact the big market. But this is where the term price taker comes from. Over here you've got Farmer X. And Farmer X, we're looking at how Farmer X responds in the marketplace. And he is taking his price as a given. So this should line up. So that's PE. And think about it this way. Is anybody at Eastern Washington farmer? No. So, a huge amount of the wheat. As a matter of fact, I think Washington may now be the largest wheat producing state in the United States. It may be the largest governmental body in the world producing wheat. We produce huge amounts of it. But we sell these to, the farmers sell them to co-ops. They all belong to co-ops of one sort or another. But the co-op price is really a national price that comes off the mercantile exchange in Chicago. So the price of corn is tied in with the price in Washington, is tied in with the price of corn in Louisiana and Indiana and Kansas and every place else. And you go, if you're driving across the United States, this is great. It's 3 o'clock in the morning, everybody's asleep, you're at the wheel. Turn on the local AM radio station and you will get the farm reports. And all they're doing is talking about price of wheat, price of corn, price of soybeans. You get a 45-minute show on prices of grains. Everywhere you go, these little tiny places all have the agricultural radio stations. And they're announcing not this local price, they're announcing this price. This is what we're getting now for corn. This is what we're paying for corn. It's given in the marketplace. This guy is a taker. And the reason he's a taker is he has no incentive to charge less than PE because the producers, or excuse me, the granaries will buy as much corn as he can sell them at that price. So he could sell 10 bushels or he could sell 500,000 bushels. He'll still get the national price for it because we're talking about trillions of bushels total. So there's no big impact in the marketplace here. If he tries to hold out and sell for a higher price, the co-op goes, sorry, we're not buying, because they can buy from everybody else at that price. So they have no incentive to buy it at a higher price from him. So he's truly a price taker and he's truly stuck, so to speak, on PE. So that's how we get this price taking situation. And these are, lots of goods actually replicate price taking. Gasoline does, heating oil does. A lot of produce commodities do. Their transportation costs will alter them a bit, but not as much as you would think. So we've got Farmer X out there. I guess I'll introduce this now because we'll talk about it a little later, just so you know. I know of farm groups in Eastern Washington who have tried to group together and distinguish their wheat from other people's wheat. Cannell, that's the place. Cannell, Washington, put together this big, 20 farmers got together and decided they were going to specialize and sell Cannell wheat and try to get an extra $1 a bushel or whatever for it, and they put out advertisements, and they did all this advertising and didn't sell any wheat because the guys that bought wheat picked it up and looked at it and said, oh, this is red such and such, used for such and such, and so is this from your neighbor that's not a member of this. Didn't work. This stuff's homogeneous. The market's going to see that it's homogeneous, and distinguishing yourself is a difficult process. So this farmer's got PE that he's sort of stuck with. He's got some marginal cost curve that looks like that. And this PE, every time he sells another bushel of wheat, how much money is he going to get? PE. So that's his what? What else is PE besides price? It's marginal revenue, right? This is also marginal revenue. That's the marginal amount of money he's getting every time he sells a unit. And what we were looking at last week was that this guy is going to maximize, if he's going to produce wheat, that's how much wheat he's going to produce. Because he's going to produce where marginal revenue equals marginal cost. That's going to maximize his profits. So, profit maximization is where marginal revenue equals marginal cost, or where total revenue minus total cost is the max. So, we're saying here, we're going, well, does this guy make profits? We'll start off, we're going to go through 3 scenarios. We're going to go through a scenario where it actually makes no profit. And what we mean by no profit is this. We say he's not making a profit. We say it's already built into his costs that he has to make a 5 or 10 or whatever % rate of return. He's making a normal rate of return. So when we talk about profits, we're saying, oh, this guy's making more than you would normally make in this business for whatever reason. So we're gonna go through 3 scenarios. One where he's making no profit, one where he's making profit, positive profit, and one where he's making, actually we're going through 4. One where he's, one where he's making profit, one where he's making no profit, he's just getting exact normal rate of return. And 2 scenarios where he's losing money. One, he's losing money, but he continues to produce stuff. So we see firms all the time. You pick up any Wall Street journal and you'll see so-and-so's losing this much per share. They continue to produce goods and services even though they're losing money. And then all of a sudden you'll hear, oh, such and such is shutting down. So at some point they're losing money and they stay open, they stop producing. So there are 2 scenarios that are associated with that. So the first one says that here's an average, well, let's do this one. If your average total cost curve, look up a second. Is exactly, the minimum of your average total cost curve is exactly at the point where marginal revenue equals marginal cost, where they're crossing, you have 0 profit. And keep in mind what this is saying. It's saying marginal revenue here is also equal to average revenue. In other words, keep in mind, I just confused that. So keep in mind that every time this farmer sells a bushel of wheat, he gets P dollars. Let's say it's $3. Every time he sells a bushel of wheat, he gets $3. So marginally, he gets $3. Every time he sells one, the marginal revenue is $3. But what else? What's his average revenue? Well, if he sells 10 bushels, he gets $30. He gets $3. So in this particular case, average revenue and marginal revenue are the same thing. That's because this one is a straight line. So, what's average revenue times quantity? That's total revenue, right? That's just a definition. Everybody just think about it a second, just so you have it, so you don't stare at this later and you don't have it. Okay, and the same thing applies for this is also at this particular point, that's average total cost too, right? So at that point, we've got average revenue minus average cost is equal to 0. There's no difference between the two. And there's no real sleight of hand here. We're just saying, because we drew this way, because we're invoking this zero profit thing, average total cost, average revenue, and marginal cost and price, they're all the same thing at this point. So there's no profit. So that means the firm's just getting a normal rate of return, and if he's going to, for instance, sell his firm, somebody's going to come in and buy it for a normal amount of money. We're going to look at how much money he's making and go, okay, I'll buy it for this much. That'll be a little clearer in a minute. Okay, before I go on, before I start invoking profits or losses, does everybody understand where these came from? If you don't understand it, stop me now. Does anybody want me to go over it again? Okay, do it. So, let's just do this part here. You know what price is, right? Price is $3. We invoke that. And we know at this particular point, so price PE is $3. That's the price that's given to us in the marketplace. And we know that this guy's stopping production where those cross. So marginal cost is equal to $3. You okay with that? Everybody okay with that? And we also know that average total cost is touching right there. So what's it equal to? Average total cost is equal to $3. And we also know that every time, if he sells 10 of them, he gets $30, and the average revenue is what? $3. So that's where the $3 comes from. At this level of output, all these things are equal. They're all right at this point. That's all we're saying here. And therefore, we're saying, in order to get total out of an average, you just multiply it by quantity, right? So, average revenue times quantity equals total revenue. Average total cost times quantity equals total cost. So, average revenue minus average cost equals 0 in this case. That's all we're doing. You starting to see it? Okay, so in this particular instance, the way we've drawn this up here, this guy's got a farm, he's getting normal rates of return, he's producing his Q-star number of bushels and selling it in the open market. Okay, so that's situation number 1. Any questions? We'll come back to it. What do you do? Okay, so now we're going to move to we'll go ahead and invoke our for some reason, the price or the supply, there's a drought somewhere, but not in this guy's neighborhood. There's a drought somewhere else. So this guy's in Indiana, this guy's in Washington, and there's a drought in Indiana. So the supply's cut back. What if the supply's cut back in the national marketplace? What's going to happen? Price is going to go to P2. So we have a national increase in price. And if we look over here, let's just replicate this. Okay, this is where we started from. So this is the old price, and this is the old quantity. So this diagram is identical to this diagram. Okay? Now all of a sudden we have this increase in price. So we're going to go over here. And we'll call that P2. Yeah, we already did call it. Okay? What is this guy going to do? Farmer X is sitting on his combine, listening to his radio station at 4:30 in the morning, driving down I-90, and he hears all of a sudden, oh boy, the price of wheat just went up to $5 a bushel. So this was $3 down here. Now this is $5. $5. What's he going to do? He's going to increase production. He's going to say, oh, I'm going to maximize where marginal revenue equals marginal cost. Well, here's now where my marginal cost curve across, this is P2 equals marginal revenue equals average total cost, et cetera, et cetera. He's got a new line to deal with here, the P2 line. So he expands his output. This is where expansion occurs when we talk about moving along the supply curve. When price goes up, it's because the firm sees it and goes, oh, I'm producing right here, right now. That's where I'm starting. Look up. I'm starting here. If I stop here, I'm going to give up the fact that I can expand out to here, and my marginal cost is going to go up, and I'm going to give up this much profit. I need to expand. And he keeps expanding, but his costs are rising until he gets here. So he's now expanded his production, so he's at Q2. Got it? Yeah, no, maybe, sort of. So now we say to ourselves, oh, something's happened. His average total cost, whoops, his average total cost is less than price. And you can see that right here. At this quantity, look up, some of you don't get these graphs very well. You go up, at this particular quantity, the average cost is here. So it's like $3.20. And his marginal cost is still higher, and his price is higher, his marginal revenue is higher, but his average total cost is down there. And on average, okay, what's that? That's profit. That's return above the normal rate of return. His average cost is $3.20. The price he's getting is $5. He's taking in $1.80 per bushel over what it's costing him in the marketplace on average. This is profit. Does everybody see where that came from? Questions? Ask questions now. Okay, now I'll ask you the next question. So if you're sitting, and this is your farm in Iowa, in Washington, you got to stay in Washington. This is your farm in Washington, and your farm is worth, you have 160 acres, you have a quarter section, that's small for wheat farm, you have 640 acres. And it's all in production, so it's all wheat. And you can get $1,000 an acre last week for this farm. And the reason you get $1,000 an acre is because somebody else, like you or me, says, I want to be a wheat farmer. And you drive over to Eastern Washington, the guy's got a sign up that says for sale. And you look at his books and you go, if I buy this farm for $640,000, I can make a 5% return on my investment every year by producing the same amount of wheat he produces. So that's his output is determining what the value of that farm is. And the value, I just came up with a number for $1,000, but that's the number that we're saying that somebody's willing to buy that and get a normal rate of return. He's getting zero profit, which means a normal rate of return, which may be, just for kicks, say 5%. And he can sell his farm for $640,000. Does that work? Yeah. Okay. Everybody with me? Okay, you're out. And so you drive back here, you have a big smile on your face, you're going, I'm going to get myself a wheat farm. And you take your $640,000 out of the bank, and you drive back to Eastern Washington as fast as you can, and you start to take it out of your pocket. The farmer goes, wait a second, I got somebody else who just drove up and said, I'm willing to pay you $900,000 for the farm. Why is he willing to pay $900,000 for the farm?
Because the supply went down.
Keep going. Why are you, last week you would have only paid $640,000 for this farm. Today, you're willing to pay $900,000 for this farm. Why is that?
Because you can tell that your profits will be risen.
Because now you have profit. You have above a normal rate of return. Okay? Do you get that intuitively? I mean, this is happening constantly. This is what you see happening in the marketplace. This is what happens when you see that such and such a firm lost $6 billion last week, and some other firm goes ahead and buys it for $12 billion. And you go, how the hell did that happen? They lose the money like crazy and somebody's buying it because something's happened with the way their capital is invested. And what's happened is all of a sudden the capital cost of this firm has changed, which is part of your fixed costs. Your fixed costs are going to change. So your variable costs don't change, your marginal costs don't change, you're still using the same fertilizer, all that's happening. But all of a sudden the value of this firm gets bid up. And if in fact it's just added on to your total cost, what's going to happen to your total cost? The price of the firm is going to get bid up until you're at average total cost 2. How much are you making in profit now? So you're the new guy on the block. You just spent $900,000 for this farm. What's your rate of return? Come on, you can tell me exactly what it is. Everybody knew what this firm was worth. Everybody knew what it was producing. They all know what the price of corn is. They all have the same expectations. And they auction off the farm, and it turns out to be $900,000. How much profit do you make? Zero. You're back to normal rates of return. The price of the farm went up until you were just going to get plain old normal rates of return out of it. That's an adjustment you see in the marketplace. So, same thing's happening in Seattle, if we want to generalize with houses, for instance. So the rental market in Seattle is such that, their one-bedroom apartments are selling for $1,800. Well, 5 years ago, those apartments were renting for $1,000 a month. But the rental amount has gone up. What's happened to the price of buying one of those buildings? It's gone up to absorb the profits of those rental properties. So when those profits occur, the fixed cost of owning the property, the capital cost, goes up until the new owners get a normal rate of return. And this happens it happens in art, it happens in houses, it happens in real estate, it happens in the stock market every day. So, a good one to think of. So, suppose you think that Apple ought to give you a 10% stock. Go buy the stock. Apple ought to give you a 15% return a year. And that's dividend plus depreciation, or appreciation. So this is Apple stock. Anybody have their phone on? Anybody have it? Type in APPL in Safari, or whatever you use, Google or 132.27.
Right now it's at 133.
This is a whole bunch of this morning. I thought it was going down. 133 what?
0.00.
Okay. There it goes. It's now 133. In December, actually, when did the iPhone 6 come out? August? Fall, September? So when the iPhone 6 came out, the stock was at about $89. And everybody's looking at it going, wow, this is really cool. And then about a week later, people started to realize they're selling an awful lot of these phones, and they've started selling them in China. They're selling more phones than we thought they were going to sell. And they're selling them faster. And on all these Apple phones, Apple 6 phones, they now have Apple Pay. So they're going into a whole different line of work. What happens to the price of Apple stock when people start going, oh, they're going to sell a lot more of these things than we think? It starts going up. How does that get accounted for? That goes up in the price of the stock until now it's 133. But the people that are 133 are thinking, well, at 133, I'm going to get my 15% rate of return. The rate of return they're expecting hasn't changed. They're still expecting the same thing. It's their expectations that have changed. They think they're going to be more sales. They had huge sales in China, which is why this went up this way. All that's happening here is the price of this thing went up. And the price rise got absorbed in the capital value. We're seeing that in the ownership value of this thing. So that the Apple people that are buying it today think they're going to get a normal rate of return. What we'll see is the opposite can also happen. This applies to real estate, it happens to stocks, it happens to bonds, it happens to art, sort of. Does anybody follow the art world? Is anybody into art? Do y'all know who Paul Gauguin is? to see what the painting sold for 2 weeks ago. I could write it down, one painting, some guy from Dubai. If he had it on it, he got it. So hopefully it wasn't in that, office. $311. Those are hard to explain because they're sort of outliers. But we'll come back to things like that later on. This is the sort of adjustment. So this is adjustment number 1. When price is above average total cost, which is what it is here, and this is where you see that, there are going to be profits. And those are returns above normal rates of return. The value of the asset's going to be bid up until those profits disappear. That's part of the dynamic in the marketplace. And it's a dynamic that's going on all the time. We're going to come back to this 100 times in the next 2 weeks. So do you see this? Do you see this process? Very straightforward process. All we did was increase the price by moving along the demand curve with a shift in supply. We could have done it by shifting out the demand curve. We could have done it by imposing more regulation. Anything that changes that price upward is going to have this impact. I never put this up here. This is where we see the individual firm expanding production. Oh, I put it over there. Never mind. Don't confuse. So here you see the expansion. I'm going back to the original position here. So here I am. It's producing Q8. It's at our original price PE. Okay? Everybody turn the clock back a bit. Okay, now we're going to say, first, for the Congress gets rid of the ethanol program. That's on the table these days. And so demand shifts back. And what happens to price? It goes down to PE3. So demand's decreased. In the US market, the price of corn has gone down to PE3, which we'll go ahead and say is $2. And there's $2, and here's the marginal cost curve. What is farmer X going to do now? He's going to cut back. Marginal revenue equals marginal cost now here at QE3, or Q3, Q star 3. Right at this point is where marginal cost is crossing the marginal revenue curve. Everybody with that particular move, okay? So all we did there was just change the price. So what happens to this guy's balance sheet? What all of a sudden is he making profits? Is he making zero profits? What's going on? Yes?
He's going below the normal rate of return?
It's going below it because at Q3, so look up now. In Q3, we go up to where his average total costs are, and they're all the way up here. They're at 320. So on average, he's taking in $2, and on average, it's costing him $3.20. What is this stuff?
Loss.
That's loss. He's now taking a loss. So in the instance we had over there, the price went up. We could see profits. Now he's got a rate of return below the normal rate of return. And he's taking losses. And again, you figure out your losses by just looking where the difference between average revenue and total revenue, or average cost and total revenue, average revenue and average total cost, which is that distance, and this rectangle is going to be the loss. So now he's taking the loss. So, does everybody see where the loss comes from? Okay. So, you went over, you negotiated $640,000 for his farm, you race back here, you get the money out of the bank, you got it in your suitcase, you're racing across, you turn on the radio, and you hear all of a sudden, holy smokes, the price of corn's come back down to $2. And you drive up to the farmer's ranch and you say, sorry, I'm not going to pay $640. I'll pay you $320,000. I just picked a number out. I didn't do some calculation in my head. What just happened? What happened to the value of the guy's farm? It dropped because the value, the income you could get from the farm dropped. And what's going to happen? I'm going to get a normal rate of return only if I lower my investment. I need to be able to get a normal rate of return out of $2 a bushel. The only way I do that is lower the price I'm willing to pay for the firm. So the firm goes down in value, and if he sells it, the average total cost curve shifts down to average total cost 3, which includes this adjustment. It just includes a change. Think of it this way. Included in your fixed cost is your monthly payment on your mortgage. That's the easiest way to look at it. It's just part of the fixed cost piece. Did you see that? Sort of? Yeah. Questions? So this is why you see firms going out of business or restaurants closing up, and they actually get sold. It's not because their equipment particularly has value. The firm actually has value, but it doesn't have the same old value it has. It has some lower value. You can still make money from it, and you can still get a normal rate of return from it, but the price you're going to pay for the firm is going to change. In rural parts of the United States, you see these huge cycles of values of real estate, and they just flow with how much of the price of corn or the price of wheat goes over long trends. So if it looks like we're going to be exporting for ages, you'll see the prices of property go up. You can see all of a sudden, well, the Australians and the Chinese are starting to produce a lot more wheat and a lot more corn. You realize that the price is going to start falling. And the value of property in the United States will start falling in the real estate markets. That's the adjustment that's taking place here. Right here. Everybody okay? Okay, we're going to take a 5-minute break, but on the 5-minute break, you should be asking yourself, when does this guy get out of business? When does he actually quit? I want us to have a little room. So all I did here was increase the average total cost a little bit so profit was smaller, or loss was smaller. Because I'm gonna introduce some other code there after the break. Okay, take a 5-minute break. If you didn't get your test back and you're here, it's up here.
I was just irritated because I was just like, this is like ridiculous. He said all these clothes and they're nice clothes too. And I think it's kind of like shoes are like afraid of that it's kind of like valuable. It is, but it's just like because they're from like they're all
Just another.
they're all so excited. Because I've never been to California and I want to stay in LA, so it's like.
Is there one other question?
Yeah.
For citizen?
Oh.
I scored on that.
I hear
You know.
I must have read it. No, I didn't. I got like a few points.
So we have this farmer in eastern Washington, it happens to be you now, since you bought the farm. And you're still abiding by the rule. So the rule always applies. If you're going to produce, you produce where marginal revenue equals marginal cost. But under the particular scenario I've drawn here, you're now taking a loss. That's the amount of your loss. Yes, sir.
Where did the average variable cost come from?
I just threw that in there. We didn't get to it yet. So in order to look at our loss, we just have to look at average total revenue and average total cost, and that gives us our loss. Okay? Why would you continue to produce if you're losing money? Think about it. What?
Because it might go back up.
Even if you think it's not going to go back up right away, why would you do it? Is there any reason that you can think of? Is that actually, you can see it up here. The answer's up here. Is there any reason that you can just think of why you would go ahead and say, I'll keep producing? You're generating some money, and you're generating more money than what? Than not doing anything. In other words, you've got average, you have some cost to producing the good, right? But it's divided into two different categories. One of them is fixed costs. In other words, if you shut the farm down, you are still going to have to pay your fixed costs. So what the rule is, as long as you're covering your variable costs, you don't close down, because the extra revenue is going into paying at least some of your fixed costs. So, in fact, you can actually go ahead and say, as long as, look up, as long as price is higher than the minimum of average variable costs, you'll keep operating. Because as long as price is higher than this, you're going to be able to contribute some money to fixed costs. In other words, you'll cover some of your variable costs. As soon as price falls below this, what happens? Well, you have your fixed costs, right? And you have these extra costs, variable costs, and you're not even covering them. So let's get out of business. So the rule is, you exit when price falls below, price is below average variable cost. And the reason is, you're not covering your variable costs. You're actually incurring higher expenses. Does everybody understand that, at least intuitively? We're gonna stretch it for a second. Questions? Everybody okay? I don't know the answer to this question. I keep thinking. So you're driving across eastern Washington, you get your $640,000 in your pocket. And all of a sudden you realize, holy smokes, price is below average variable cost. Am I ever gonna buy this thing? Are you ever gonna buy it?
You actually sell the assets of like the factory and stuff. Like you can sell the machine stuff or
Sort of.
liquidated kind of
At what price?
the price you paid for.
But what do you have to lower in order for you to be willing to buy this thing?
The variable cost.
What else do you have to, might have to lower?
So
You have to lower your total cost somehow, right? So what do you have to do?
Well, if you buy it for cheap, it could be a good investment, right? Because once it starts rising again. it'll be a lot
Again,
more.
you're anticipating. Don't anticipate. You can do this without anticipating.
Can you like offer a lower amount to buy the farm loan to try to gain profit?
You can keep, I'm trying to think, do you ever buy this thing? If the price is, if you think the price is always going to be P, we'll call it P4, right here. In other words, it's at the minimum of average variable costs. What's the only reason you would buy this place? You'd only buy it if you thought you could somehow lower the variable costs. And people do this all the time. They see somebody go bankrupt and they go, I can do a better job. I can have a different production function. I'm going to have different variable costs. But if you're only going to buy this thing if price is below average variable cost, if you think you can lower these average variable costs, because that's the only way you can get out of it. And the total cost, it may be that the other guy's willing to pay you to take it. Right? Here, take this. I'll pay you $10,000 for you to take my farm. Because he owes $30,000. And he's pawning it off on you. But what I'm saying here is that price will reach a certain point and this land's no longer valuable as a corn farm. Unless, of course, we're going to have some change in the future. That's not true if price is above this. If price is above this, you'll just pay less for the farm. You know, you thought it was worth $320,000, now you think it's worth $280,000. And again, this is the sort of dynamic you see going on constantly. And you see it in stocks. Okay, you'll see a stock, you'll see Caterpillar. Caterpillar's been beaten up recently. Or better yet, Twitter. Talking about stock. I won't give you the details. So, it got up, I think Twitter actually got up to $79. And then people started, then it came out with a couple of announcements, and Facebook was actually doing really well. So Facebook, at the same time, might as well do the other side of this, Facebook was about $47 at the exact same time that Twitter got up to $79. And then the quarterly reports come out, and it turns out that Facebook's sales were something like 18% higher than expected. And Twitter sales were like 47% lower. What happened?
The stock would drop for Twitter and Facebook would rise.
Yep. Twitter starts going down, reflecting the fact it's not getting advertising revenue. Facebook is now up to, I think, somebody look up Facebook. FC, I think. FB. I think it's in the mid-70s now. It may be touching 80.
78.84.
Yeah, it's just, And the reason is because it keeps adding on this advertising revenue unexpectedly. In other words, people go, oh, it's gonna go up 10%, and it goes up 12%. So it gets bid up a bit. It's been going steadily up. This one's been going steadily down. What's Twitter now? I hate Twitter.
48.47.
Yeah, it's probably gone up recently. I think it got worse than that in a while. And both of these are doing essentially the exact same thing, but expectations are different. The expectations were that these guys were going to sell more than they're selling. The expectation for Facebook was that they were going to sell less than what they're selling. So this price is adjusting. This is the same as the farm adjusting. Exact same sort of thing. And then why do people come into them? They go, oh, they're going to keep doing it. So why do people buy these places at relatively high prices? Farms, pieces of art, restaurants, because they think they can do better. They think they can sell more goods or lower costs, lower fixed costs, or lower variable costs, or somehow change that structure of costs and revenues so they're getting higher rates of return. Yes.
How does that apply to art? Like, what you mean they can do better? Like the painting set for like 3 million, or 300 million?
Well, I mean, that guy's nuts, but, I mean, it's a nice painting, but, you know, you and I could go at it for a couple hours and get close. It's cocaine, not sergeant. But, I mean, you think of, what's that, it's a really weird show. They sell antiques. Yeah, is it on Channel 9? Yeah, okay. There's a show, they sell, but it's weird, when they sell all this weird stuff, and people know a lot about the markets. And these people will sell stuff and they'll go, well, the market for this is up. So people are, you know, someone, you know, comes in and he's got a chair that he bought for $12 and now it's $12,000, right? But other stuff, like a lot of art pieces, the market will be flat because there's a lot of taste involved in those. So those will go down. And people buy art in speculation. I mean, I know people that have art in closets. They just buy art. You stick it in a closet and they just wait. They think it's going to go up, and half the time it doesn't. It's just like buying anything else. But they have a set of expectations and they pay a certain price for it. So if you have, you know, people treat art the same way they treat real estate and the same way they treat stocks. It's the exact same thing. It probably gets, I mean, it's harder to put why the value is there, but it's there. I was teaching in New York a couple of years ago, and I rented an art studio in Soho, which is down right below Greenwich. It's actually part of Greenwich Village. And these people had, it was a great big art studio, and I got it for the summers, teaching the summer class. And one day I'm staring at this picture across, this drawing across the wall, it's hidden behind a lamp. And I'm staring at it and I'm going, that's really cool, that looks like Matisse. And I go over and it was a Matisse. They had stuck it on the wall. They had bought it in like 1947 and stuck it on the wall. They had no idea what it was worth then, but they were never going to find out. They didn't even tell their kids that it was real. I asked them all sorts of questions about it. People, they're buying art just to hold art. And at the same time, there was a terrific Picasso show in one of the old meatpacking warehouses. And they had, somebody must have given Picasso lots of wine and party time. Because they took these, all they were what's the paper we draw on when we're kids? Newsprint. Big, but huge sheets of newsprint, like 6 feet long and 4 feet wide. And he must have just, they just gave him a couple colors and he walked around and did these, and they had about 50 of them. And they were, you know, they had price tags of $700,000 on them. Yeah. And I'm sure that he was laughing the whole time he was doing it. That's, you know, people are anticipating at some point they're going to be working there. This sort of phenomenon, where prices change in the marketplace, people start taking losses, people start taking profits, prices are always adjusting. This is the dynamism of the marketplace. This is the stuff that's happening all the time. What we'll do next, we're gonna move into what we're gonna see is price searchers markets, and it's gonna look different. It's gonna look different because those guys face downward sloping demand curves, and we're gonna look at monopolists, and we're gonna go, oh, they have a different restriction in the marketplace. But the actual dynamism that we're seeing here of price changing, all of a sudden their rates above, profits above the normal rate of return, or losses below the normal, that are below the normal rate of return, the value of the assets changing all the time. That never changes. That's the dynamism that goes on in the marketplace. So we'll do that next. So if you haven't started reading that, that's the imperfect competition chapter 14, I think. And you should start reading these questions and start thinking about it. And I will see you on Wednesday.